Welcome to the Skilled MBA Finance Case Study Series, where we bring strategic financial decisions to life through real-world examples and insights. Retail Development Co. is at a critical juncture, transforming a prime land parcel in King of Prussia into a thriving, mixed-use town center. To realize this vision, the company is considering a partnership with Lifetime Insurance as an equity co-investor. Financial analyst Basha Augustin has been tasked with a pivotal decision to assess whether the proposed co-investment terms offer sufficient value. The evaluation centers on projected financial returns, including IRR and cash flow forecasts, strategic alignment with Retail Development Co.'s long-term vision and control provisions, capital structure implications, and risk-sharing mechanisms. This case captures the delicate balance between raising capital and retaining value, offering key lessons in real estate finance, partnership structuring, and investment evaluation. Retail Development Co. aims to transform a prime land parcel into a mixed-use town center in King of Prussia. They are considering partnering with Lifetime Insurance as an equity co-investor. Financial analyst Basha Augustin evaluates if the partnership terms provide sufficient value for RDC's ambitious vision. The partnership structure involves a complex waterfall arrangement, including preferred returns and tiered profit sharing between RDC and Lifetime Insurance. Lifetime Insurance requires a hurdle rate before profit sharing. Key evaluation points include assessing if the internal rate of return is strong for both parties, if incentive fees and promotes are balanced, and if the deal aligns with RDC's long-term strategic goals. Waterfall structures in real estate private equity ensure fair profit allocation. Initially, investors reclaim their principal. Limited partners then receive a preferred return before general partners share profits. A catch-up provision allows general partners to align with preferred returns. Finally, promote or carried interest rewards general partners for surpassing performance benchmarks, fostering alignment and benefiting all parties. Waterfall mechanisms in real estate private equity are intricate structures that allocate returns based on performance benchmarks. They define general partner-limited partner relationships where general partners manage operations and limited partners provide capital. Cash flow modeling involves projecting costs, revenues, and exit valuations to assess internal rates of return, illustrating how distributions shift with project success, balancing risks and rewards among partners. Basha's financial model meticulously outlines development costs, including land acquisition and construction expenses. Revenue projections are derived from phased cash inflows such as commercial leases and residential rentals. Exit valuations consider capitalization rates and market comparables. Return metrics focus on project-level internal rate of return, equity multiple, and cash-on-cash returns, providing a comprehensive view of potential financial outcomes. The waterfall distribution model outlines how RDC's profit share escalates with enhanced performance, motivating them to optimize returns. Meanwhile, Lifetime Insurance secures its baseline return, balancing risk and reward. This structure aligns interests, encouraging RDC to exceed benchmarks while safeguarding Lifetime's investment objectives. Evaluating strategic trade-offs involves assessing development risk, especially for conservative investors like Lifetime Insurance. Pricing risk into partnership terms is crucial. Beyond immediate returns, consider if the town center project enhances RDC's brand in mixed-use development. Analyze how incentive structures influence decision-making and stakeholder alignment throughout the project lifecycle. Stress testing returns involves analyzing key risk factors like construction cost overruns, slower leasing pace, cap rate expansion, interest rate fluctuations, and market demand shifts. Basha must assess how these variables affect the partnership's economics and identify which party bears the most risk under various scenarios. impacting project internal rate of return, required debt coverage, and lifetime returns. Exploring alternative partnership structures, a traditional joint venture offers equal capital contribution and profit sharing, yet lacks performance incentives. Preferred equity ensures priority returns with limited upside, aligning with conservative risk profiles. Staged capital commitment reduces initial risk but complicates structure. Development management fees provide stable income, potentially reducing upside. Each structure influences incentives and risk profiles, crucial for aligning with strategic objectives. Master of Business Administration students must master joint venture structuring to balance control, capital contributions, and profit sharing. Waterfall modeling is crucial for projecting cash distributions with tiered promote hurdles. Aligning with capital partners requires designing structures that satisfy conservative investors while maintaining developer upside. Strategic decision-making involves balancing short-term returns with long-term strategic goals. Evaluating the proposed waterfall structure, RDC must consider modifications that enhance profitability while appealing to lifetime insurance. Assessing the appropriateness of lifetime insurance's hurdle rate is crucial, comparing it to market standards. Exploring alternative partnership structures can ensure alignment, addressing both parties' risk concerns effectively. Recent trends in real estate private equity highlight a shift towards conservative underwriting and the rising importance of environmental, social, and governance factors. There's increased scrutiny on mixed-use economics, especially in suburban areas, and a growing preference for staged capital commitments. The King of Prussia case exemplifies challenges in securing institutional capital for ambitious developments in these evolving markets. Financial engineering in real estate. Private equity emphasizes how structure influences behavior. Waterfall mechanisms incentivize project execution, while successful partnerships balance risk and reward based on contributions and risk tolerance. Beyond numbers, aligned interests and clear governance are crucial. Value creation focuses on structuring deals that maximize long-term value, not just square footage. Thank you for joining us on this episode of the Skilled MBA Finance Case Study Series. For further insights into finance and strategy, connect with Skilled Master of Business Administration. Reach us at +91 87553 00795 or support at skilledmba.com. Explore our case study series at skilledmba.com for in-depth analysis and expert perspectives.